7 things you need to know about debt immediately, and stay away. When companies take out large amounts of debt to expand their business, they take advantage of financial leverage, leading to low profit margins at low sales levels. On the other hand, higher sales mean greater profits, and companies with high debt are obsessed with sales. These factors can create problems for companies. So, balancing the benefits and risks associated with debt financing is essential. Below are the advantages and disadvantages of debt. The advantages of debt financing include reduced interest rates and liquidity. However, the disadvantages of debt financing include restrictions on how the money can be used. The interest payments on debt may be tax deductible, reducing your net obligation. Additionally, debt financing may not be a good idea if you need a large sum of money to start a business or to expand your existing one. Debt financing always involves risk. Therefore, it is generally only suggested to those ready to take this risk. However, there is a risk if the debt is not paid. Interest is compounded like a machine, and lenders and investors can lose a lot of money if debt financing doesn't go according to plan. Furthermore, debt financing requires companies to have cash on hand, which limits the ability of the company to add expertise. Small businesses can use long-term debt to buy inventory, hire new workers, and increase marketing. Low-interest long-term loans can help a business operate smoothly and profitably, and make additional profits. The disadvantages of long-term debts may outweigh the benefits of the latter. So, before you start your business, consider your needs, and weigh these against your potential benefits. And then, make your decision. Here are a few things we'll learn as we move forward with this video. How to be debt-free. What is debt? Is debt good or bad? Mortgages. Types of debt. Business debt. Car debt. How to avoid debt. Hello dear viewers. Hope you're having a great day. Welcome to TKI, theknowledgeinsights.com. Being part of your fine lifestyle. Before we start, click the subscribe button below, also the bell icon, as we have more insights to share with you for your fine living. Let's get started. Number 1. Personal loan. Personal loans are often higher interest loans, since they are not backed by collateral. As such, they are riskier investments for lenders. Therefore, they usually have higher interest rates than secured loans, which include home equity lines of credit and small business loans. However, personal loans have a few advantages that make them an excellent choice for many consumers. The fees associated with personal loans can vary considerably. For example, some lenders charge origination and application fees. These fees are generally a percentage of the total loan amount. Other fees can be imposed on borrowers if they pay off their balance early. In addition, some lenders charge prepayment penalties. To avoid these fees, borrowers should shop around and compare many lenders. Moreover, they should be aware of all the terms and conditions of the loan. Another disadvantage of personal loans is that they can lower your credit score. While making on-time payments on a personal loan can improve your score, late or missed payments can damage your credit score. It is better to make timely payments with a personal loan than to pay off credit card debt in advance. This will reduce your credit utilization ratio, which accounts for 30% of your total credit limit. But this is not without its advantages. Number 2. Medical debt. In addition to being extremely expensive, medical debt has negative, long-term financial consequences. In recent years, the number of Americans with health insurance has risen dramatically. Since most people don't have the money to cover a whole year's worth of medical bills, they may skip rent or mortgage payments, negatively impacting their credit score. But the situation may not be so bad for everyone. Uninsured people with medical bills are more likely to struggle to meet their other financial obligations. As a result, they may be unable to pay for necessities like food and shelter. And nearly half report being unable to make ends meet because of medical debt. But it doesn't end there. Medical debt has a negative impact on a person's life in other ways as well. Number 3. Commercial paper. The question of how commercial paper causes a person to go into debt is one that many people are curious about. The answer is surprisingly simple. Commercial paper can become a standard credit facility, depending on how the banks treat them. A bank may directly invest in commercial paper, and wait until it fails, or redeem a commercial paper guarantee, if it is in good standing. However, it exposes the bank to on-balance sheet credit risk. In the United States, commercial paper is an unsecured form of debt. If an issuer defaults on his obligations, the issuing and paying agent reports the failure. As a result, investors who hold commercial paper have very few recourses, other than to sell their stocks in the company. The risks of such a default scare the entire commercial paper market, which is why many issuers take out insurance to protect their investors. Commercial paper is an unsecured form of a promissory note, with a maturation date of a few weeks or months. Because commercial paper is issued at a discount from its face value, the interest rate is usually fixed. Large corporations issue commercial paper to meet short-term obligations. A credit rating agency backs it, but the issuing corporation isn't responsible for repayment. Number 4. Mortgages. You may be wondering why mortgages are different from other forms of debt. While mortgage debt is generally considered safe, the subprime mortgage crisis and the Great Recession taught us that borrowing more than you can afford poses a risk. Mortgages typically have long terms and are secured by real estate. Therefore, as long as you understand your mortgage, you can avoid its risks. Here are some tips to help you decide between the two types of debt. Mortgages are the most common type of consumer debt. Because they are secured by property, they have lower interest rates than many other forms of debt. Because they track the prime interest rate, mortgages receive preferential tax treatment. These loans are also tax deductible, making them a wise choice for those who cannot afford high interest rates or monthly payments. However, you should also know that a mortgage will cost more in the long run. When you can afford it, mortgages are a good option. While some types of debt are not the best options for your financial situation, others are excellent investments. While it's essential to be careful, mortgage debt is often a good option for your financial future if it can be paid off in the long term. The advantages of this type of debt include greater freedom and a more secure financial position. Number 5. Car loan. You may wonder, how can a car loan lead to debt? If so, you're not alone. Many people are in this position at one point or another. For example, paying off a car loan often means less interest over time, so if you can afford it, you should. However, if your budget is too tight, you may be in debt before you know it. While selling your car won't impact your credit score, replacing it with a new one will. Negotiating with your lender will impact your credit score, and if you choose a longer-term loan with a modified repayment schedule, it may report to the credit bureaus that you missed several payments. If you do decide to pay off your car loan early, however, you'll have less debt and better opportunities for other forms of credit in the future. Lenders take significant risks in making car loans to people with bad credit. Therefore, they typically ask for a substantial down payment and set the interest rate at 10 points higher than it would have been for someone with good credit. If you default on the loan, the lender can sell your car and recoup a portion of the loss. If you're not careful, you could pay more than you can afford and then find yourself in a similar situation. Number 6. Business debt. There are several ways to handle the financial situation of a growing business. For instance, many business owners have a CFO or an accounting department to keep track of their finances. A business owner without such a professional will have to assess the company's financial situation and create a solid capital plan. Of course, they may also be able to raise funds, but they should avoid situations where projected growth is at odds with debt. The following are some ways to deal with bad business debt. It would be best to decide whether to use your assets to pay off business debts as a business owner. It will depend on what kind of business entity you have. If your business is a sole proprietorship, you are personally responsible for any business debts. However, most partners are also responsible if you have a partnership. In contrast, a corporation shields its owners from personal liability, and certain hybrid entities don't require business debts to be paid off with personal assets. A business debt schedule lists payments in order of maturity. This is useful for bookkeeping, strategic decision-making, and making payments on time. You can use a spreadsheet program to create a business debt schedule, or you can use accounting software. A business debt schedule will help you stay on top of your monthly payments and manage your cash flow. So, keep these tips in mind when looking for a loan for your business. Number 7. Is debt beneficial or detrimental? Debt can help your finances in several ways. For example, it allows you to borrow money to finance an education, or a better job, or it can help you save for a vacation. Debt is often used for various reasons, but there are some instances when it is not. Using credit cards or other loans for unfavorable reasons is often unproductive, and will hurt your credit. The best way to avoid these situations is to understand the risks and rewards of each option. Credit cards and payday loans are two common examples of bad debt. Credit card interest rates can be high, over 20%. These rates aren't cheap. It's easy to get into debt and pay much more than you should. Moreover, the debts can spiral out of control. If you are in debt and have bad credit cards, make sure you pay them off on time, so that you don't have to pay high interest rates in the future. Commercial real estate developers use debt to build their buildings. They use the money they borrow to pay for building expenses and debt services. On the other hand, churches do not have tenants and, therefore, can't borrow money. But if you use your credit cards wisely, you can turbocharge your returns and get rich. So, are credit cards bad? Indeed, they can help you get rich, but they can also hurt your finances. Takeaway: if you've been struggling with money issues for any time, you've probably noticed some common symptoms. For example, you may have noticed that you don't want a new car anymore, but your house is no longer worth what you spend on it. Or you may have noticed that your bills keep piling up, and you're getting sick when you think of a $10 fast food meal. These are all signs that you're struggling with the emotional effects of debt. Drowning in debt can take a toll on your happiness and ability to make crucial decisions. The emotional strain of debt can be almost as difficult as losing electricity or power. When you borrow money to pay for necessities, you may feel happy for a short time, but soon find yourself wondering whether you need that item in the first place. It's estimated that nearly half of American households are in debt, from student loans to medical bills, car loans, mortgages, and even business loans. Whether it's student loans or credit card debt, people who are buried in debt aren't living in a happy place. In addition to mental health issues, many people drowning in debt experience depression. This state can interfere with every aspect of their lives, including job performance, productivity, and ability to communicate with coworkers. It may even interfere with physical capability, which makes it difficult to get anything done. And if you don't do anything about it, you'll be unable to make an income and pay bills. Dear viewers, we believe that seeing this video would have piqued your interest and sparked your curiosity. We'd appreciate it if you could leave us a remark in the comments section below. As always, we appreciate hearing from you.